Awesome. Okay. All right, guys. So let's get rolling. Um, so basically, what we do, we call it trading. There are different things somebody can trade. What we trade, we call it stock. Okay. Um, I'm hoping everybody can see my screen. If you cannot see my screen, please let me know. But the thing we trade, we call it stock. So there are other things people can trade, like options. They can trade futures. They can trade currencies and a lot of other things. But we do trade stocks. We also trade options. So to start with, we'll start showing you guys about what the stock trading is. Okay. So there are different companies out there. Take companies like Apple, like Amazon, like Microsoft or Google. So these are different companies and they are publicly traded. Publicly traded means they have put themselves out there, sliced themselves up into small parts, small slices, so that like a big number of people could purchase those slices of those companies. You could consider it like a pizza, right? So like a pizza, you can probably not eat an entire pizza by yourself, but if you found a good slice of a large pepperoni pizza, you could probably eat one slice or two slices, probably not the entire pizza. And some people could probably not eat two slices, they just go with one. It's up to you and how much you feel you can eat or how hungry you are in the moment. A lot of those will depend. This is a different type of pizza. You have one type of pizza called this a company, and then this one could be a different company, right? And you also have another company, and this one is a vegan pizza. So you have pepperoni pizza at first, then you have the ham pizza, and this is a vegan pizza. So pepperoni pizza is very common, probably the most expensive one if you like, since people love pepperonis, more than anything else. So let's say, they are selling the slices of this, and the slices of this could be, let's call this maybe um, $10 a piece, right? So that would be the price of a slice of pepperoni pizza. And this ham pizza, I don't know, but people are not too much into ham like they are in pepperoni. So maybe this can go for $5, right? A slice. And this one is a vegan pizza. Although vegan might be healthier, but people are not so much interested in that. So maybe you'll go with a $2 a slice of this, right? So let's assume you have 8 slices per pizza. So the entire pizza for the pepperoni would be $80, $40 for this, right? And then $16 for that. You cannot eat the entire $80 pizza, but you can, eat only for $10. That's your budget. That's your stomach budget, if you like, right? So every type of pizza is a different company. Like when I mentioned Apple before, let's say I'm gonna go with Amazon on this one. It's more expensive, right? And let's say this is Apple, or you know what? Let's call this Google, okay? And let's call this Apple. Could be anything, guys. I'm just taking examples, right? So, all right. So different companies will be priced differently. So the entire Amazon can be, more than $1 trillion, right? So one common individual would not be able to purchase a company for $1 trillion, but if they slice it up, then you can buy a piece of it. And every slice of pizza in the world of stock market, we call that a share, right? Call that a share. So a share of Amazon, well, a share of pepperoni pizza is $10. A share of ham pizza, $5. A share of vegan pizza is $2, right? So what we do is, let's say, for example, I mean, why do we get into this business? This is because those prices can change. The slices of pepperoni tomorrow can go down to $1. Let me say why, for example. Let's say some kind of health communique just comes out today and tells everybody that pepperoni is causing cancer in everybody. I can tell you, pepperoni pizza's price is gonna go down to $1 or less the next day. Why? Because who would want to buy this? So if people don't want to buy pepperoni anymore, then it's just gonna go down. The price is just cannot be sold for $10 anymore. Where it was more expensive than every other type of pizza, that's no longer gonna be the case. So if you purchased a slice of pepperoni pizza and you were trying to sell it back to somebody else, right? Then what's gonna happen is you're gonna lose money because the price went down, right? So the price just went from $10 down to $1, right? That's not good. When I say not good, because that's not what you're hoping for, right? Let's say that happened to pepperoni pizza, but nothing happened. They did not say anything in that health communique about ham pizza. So the price of that one remains the same, right? But when they were talking about that same pepperoni pizza being bad for you, they also mentioned that vegan pizza or eating veggies actually will decrease the chances of people having cancer. And now all of a sudden, everybody starts buying vegan pizza, right? Vegan pizza. And then what happened? So the price of a slice of vegan pizza that was at $2, all of a sudden just shoots up. And then now it's the new kid in town, and then you're buying one slice of it for $15 now, right? So what happened if you purchased a slice of a vegan pizza before for $2? You can sell it back to somebody else right now for $15, and you just made the profit, which is a difference of the two. In this case, that would be $13, right? Uh-oh, am I out of ink or something? All right, so that's what will happen, right? You just made a profit of $13. Can you all hear me? Still want to make sure if I'm okay, because it looks like I lost connection for a minute.
I can hear you.
Okay, perfect. Thank you. All right. So basically, that is why we get into this business. There is the potential to make a profit when the price of something that you purchased increased, right? So I just gave you this analogy of pizzas, different types of pizzas, where the price of one can go down, where the price of the other can go up. And if you allocated, a small amount of money to purchase that company, maybe you lost on that one, but you made a good profit on the other one that went up. So what we teach here is to teach you, what we do here is to teach you the best strategies, the best techniques you can use to maximize your profits. You cannot completely avoid all losses. Loss is a part of this business, it will come, but you can maximize your profits and minimize your losses. That's what we do by teaching you how to do this. Otherwise, everybody understands how do you make money in something? You purchase it cheap and you sell it more expensive. That's how you make money, right? Everybody knows that. But when is something cheap? When is something expensive? That is the $1,000,000 question. If anybody could answer it 100% of the time, everybody would be a millionaire, right? But that's not the case. Not everyone is a millionaire. In fact, I have to let you know before you get into this, FYI, it's very important to know that I'm going to write it down here. And I'm going to make it in big characters so everybody doesn't say I didn't say it. 90% of people who do this lose money. Okay. 90% of people who try to do this, they lose money. So the odds are not exactly in your favor. But if you practice the good techniques, you will be able to make it, right? But that would not negate that statistics. This is statistics. It's been established. Yeah, that number varies too. It's not the same every year. Some years it can be 80% of people lost money. Some other years it can be 95% of people lost money. Right. So it's not a constant 90%, but it's always around that area. Right. But that number is not strange because it is also true for any other type of business you would try to do. 90% of all businesses go out of business within the first 3 years, right? So any type of business you try to do, that happens to. It's not just in this. So um, if you don't like that idea, then that's not your thing. Then, right? It's not your thing. Okay. Um, Before I move on to the next thing, do we have any questions so far? Okay, no question. And if you have any question at any time during this webinar, please stop us and then ask the question and we answer it right away. Okay. Now, you may ask me, how do you find slices of Amazon to buy? How do you find slices of Google or Apple or any company for that matter to buy? Where do you find that? Well, there is this type of businesses, we call them brokers, right? So a broker is a company that gets the shares out of an exchange. So let's say, for example, Amazon wants people to be able to buy its shares. So Amazon will register with one of the stock exchanges, right? So the stock exchanges, for some of them is the New York Stock Exchange, another one could be the NASDAQ and many other ones. These are the most common ones I just said, right? So they register with those exchanges. If you wanted to buy one share of Amazon, you would not need to go to that exchange to buy it. You need a broker. So the broker will get the shares from the exchange and then give them to you. So that's how you would do it. So what you need to know is what broker you want to use. And when you want to buy a company, it's good to know what exchange that company is registered with, because some of those exchanges are not legitimate. They don't have good standards. So you don't want to be scammed. You don't want to be part of a fraud. So because you can potentially you lose your money in that. So some of the good exchanges are this NASDAQ, right? NASDAQ. Uh, I don't know why that thing is not okay. Sorry, NASDAQ. There is another one called the New York Stock Exchange, right? There is another one called Amex, and so on, right? There is the ARCA as well. No, ARCA is a electronic something else. Okay, so let's keep these three for now. There is one called over-the-counter, right? This one has this abbreviation OTC. This is one I warn people against. If you see a company is registered with the OTC, then do not purchase the shares of that company because it may not be fraudulent, but chances are it can be fraudulent, right? You don't know. But companies that are registered with the NASDAQ, NYSE, Amex, likely not gonna be fraudulent like this. So you would not lose your money like just like that. So it's better to only purchase shares that are registered with those. And I will show you on your platform where you can do this kind of activity, where you can find out what exchange a company is registered with, right? So for now, let's talk about what brokers you can use. So there are different kinds of brokers. Some of them are more professional than others. Some of them are simpler. So it will be up to you how you pick them. But I always advise people. Let's talk first about one called Robinhood. You might have heard of Robinhood, right? Before. So Robinhood is a stock exchange. Is a broker. Sorry, Robinhood is a broker, And it's one of the very simple brokers. It makes everything easy for you. So if you are into easy things, then Robinhood could be what you use. But it comes with a price. Not everything easy is the best, right? It's not the best in many regards. It's not going to allow you to do a lot of things we will teach you to do. It will not give you as much information as you could find on some of the other ones. Um, but it could be okay if you want to do long-term trading. Let's say you analyze a company, you find out that that company is good, and you want to invest in that company for the long term, then that would be that could be okay if you wanted to use that one, right? But if you're gonna do more, you want this to be more like a business to you and more like short term, where you can every day check the price of everything and try to maximize your profit kind of thing. So Robinhood is not the best for, if it will not allow your orders to be filled quickly, and you don't have a lot of visibility on a lot of activities going on in the market, right? Plus it only has a mobile app. It does not allow you to trade on your laptop. And why do I think laptop is better than a mobile? Because you have, not only do you have a bigger screen, but you can have multiple area of visibility at the same time. You can have multiple areas multiple things that you're looking at together, right? And that allows you to make quicker decisions, because the market can be quick if you're trying to do a lot of activities within the day, right? Okay, there are other um, brokers like the Charles Schwab's, right? You also have Fidelity, all right, like this. I'm showing the logos, so if you decide to download one of them, you know exactly which one you're looking at, all right? There is also TradeStation. These are all good. You also have TD Ameritrade. TD Ameritrade is the one I'm gonna talk about most, because it's a very professional one, just like TradeStation is. I have both of those right now myself, right? So TD Ameritrade, I've had it for the longest, for more than 5 years. It's great. It's very professional. It gives you a lot of details, and most of them for free. You do not have to pay a dime for them, and it's the one of the software that allows you to get very good charting, right? So the charts, I'm gonna show you what they are made of and why do you need them. Um, so it's now even allowing people to trade for free. So not only do you get data for free, but you can trade for free, meaning you don't pay them for your tradings, right? If you buy something, you don't need to pay them in order to buy that thing. When I say thing, I really mean stocks, right? That's what we were talking about before. Okay. So I will show you their platform in a while, and how to, how to create an account with them, and stuff like that. Okay. And by the way, when I say create an account, you will just need your social, but you can trust them. No worries with your social. And um, you can start trading in a simulation with them. So at the beginning, you don't even need to put money on the account that you create with them, but you need to have a social security number in order to apply with them. If you are international and you would like to start, I can show you some other brokers that you could use for the international. But for now, let's go with the assumption that everybody here is in the US. Okay, so all right, let's talk a little bit about chart. If we don't have any questions about this, let's talk about charting, right? So I mentioned earlier about different slices of different companies, and I showed how the slices of a pepperoni pizza could go from $10 to $1 overnight, if you like, or over the course of certain time, right? Or how the slices of a vegan pizza can go from a $2 of today's price up to $15 tomorrow, because people realize this one, not only is it not going to harm you, but it actually increases the chances of you not getting cancer, for example. If there was such communique coming out from a um, um, credible person, then that could shoot up the price of a vegan pizza, right? Okay, so that's exactly the same thing we expect in the stock market world. So let's say currently the shares of Amazon are being, no, let's take something cheaper. Let's go with Apple. So the shares of Apple, right? Every company has a symbol, by the way. For Apple, its symbol is AAPL. Don't worry about remembering them right now, because your broker will allow you to search for the name, and then they will show you what symbol is associated with that. So you don't have to worry about remembering them, right? So this is Apple, right? And currently one share of that costs about $300. Don't remember the exact price, but it should be around that, okay? So if you were to buy this right now, you would hope that it goes up. If it goes down, you would be losing money. If it goes up, you would be making money. So if you bought this today for this price and tomorrow it goes up to, let's say $350, right? $350. So your profit would be $50 if you bought one share. If you bought 10 shares, your profit would be $500 and so on. But in order for you to buy 10 shares, you would have needed $3,000 to invest in the first place. So if you do not have $3,000 to invest, then you would not be able to make $500 on that move on Apple, right? Why does Apple price changes anyway, right? That's a good question to answer at this time. Prices change for different reasons. There is this thing called greed you might have heard about. There is also fear. You might have heard of those. In this market, the stock market, these are the greatest movers of the market. There are other things. There's also value, right? Those kind of things. But for the most part, it's greed and fear that moves the market. If you are thinking Apple is going to launch a new, let's say a new type of phone that's like out of this world. Nobody's seen this before. You're thinking smartphone, and the smartphone is like nothing compared to that other phone Apple is about to release, let's say next quarter, right? What do you think? If Apple successfully launches that thing and it takes off, it shows to be really more valuable than the current smartphones that we have, then that's going to just maybe double the value of Apple as a company, right? So if the entire Apple was worth $1 trillion, then you can bet after that thing, maybe Apple is going to be worth $2 trillion, right? So don't you want to be part of that company, right? You cannot buy in the entire Apple for $1 trillion right now, but I can buy a piece of it, a slice, right? And the slice is right now $300. So if Apple doubles in value, then I can expect my slice to go from $300 to $600. That would basically double my money just like that, right? So that's why we get into this. But what would make you try to get in? It's because of greed, right? The greed is not necessarily a bad thing. It's actually a good thing. If you're not greedy, you're not gonna try to make a profit out of something you think might rise, might grow, right? But let's say, for example, some kind of crazy news came out about Amazon, and they say Amazon, right, is about to lose a lot of market shares because Apple is about to launch a product that will directly compete with one of the Amazon's product, right? So let's say, I don't know, Prime Video. Amazon has this Prime Video where you can watch movies similarly to Netflix, right? So let's say Apple is about to watch something that is going to be revolutionary, and it's going to allow you to watch movies too, but in a much better way, better resolution, whatever, right? I'm just imagining. So let's say that's going to happen. What do you think? If Apple is going to lose that kind of revenue stream in the video world, the value of Amazon will likely go down. So if Amazon today is being sold for $2,000, right? Then maybe, right? I don't know. So let's say $2,000 of today, maybe then it will go down to 1,500 because of that, bad news about Amazon. So if you were part of this, what's the first emotion you're gonna have right now? Oh my gosh, I have invested $10,000 in Amazon. I don't want to lose that. What's happened to you right now? You just had what they call the fear, right? So the fear is what's driving you right now. So because of the fear, what do? You go out and you sell the shares you had at 2000, right? You don't want that to, you don't want to have, you don't want to be part of that drop, right? You just sell those shares, right? That you had. And when everybody is thinking the same way you do, go ahead and selling their shares, the price of Amazon will really drop to probably at 1500 that you talked about, right? So the value of Amazon, okay, let's say Apple finally launched that new video streaming product, and it does not do very well, right? It does not do very well, and Amazon is still doing well. So what happens after a few months, people realize that, I really thought that app product was gonna overtake the Amazon video, but it did not. So I guess Amazon is still valuable. So I think I'm gonna go back and buy Amazon again. And then people just go out and they just buy Amazon again at the $1,500. And guess what happened? The price of Amazon just shoots back up to 2000, right? So what happened here? You had a fluctuation of the price of one company when the value of the company did not really change very much. But it did change because of those two things, right? Greed and fear. Because if you realize the value of Amazon did not drop, and you know the price is right now 1500, so you think that's an undervalue of Amazon, you wanna make some of that profit back up to the 2000, so you get back in. So that's greed, right? And then of course it goes back to 2000 because a lot of people thought like you, the price really goes back up and you make a profit of $500 on a share, right? So basically that's how it works. Now, why, I mean, this is pretty simple. Why is it that 90% of people fail in this? That's because something, um, you're not always able to predict what's going to happen, right? So when I say you're not always able to predict that accurately. So sometimes you will think the price will go down, it did not. Sometimes you will think the price will go up, but it does not. And with that, when you're wrong, you may be wrong, and lucky you break even. You sell your thing at the same price you bought them, you're out, you lost nothing, or you can sell them for a loss. That can happen too. There are ways we try to think of what may happen next, right? And I'm about to show you right now. So when I tell you about a chart is not much than it's nothing more than just a way to graphically represent the price movements of a company. So let's say I have, I have day one, right? And day two, day three, day four, day five, and day six, okay? I don't need to write them. I hope you remember. Day 1, 2, 3 through 6. And on day one, so let's say these are the price levels. You have, let's say at this level, you have $100, right? They're all dollars. At this level, that's 200. You have 300 at this level. So the higher you go, it means the more expensive that thing is, right? This is basic level of charting for the stock market, guys. Okay, so let's say this is day one, day two, day three, and so on. So if I'm drawing a progression of the price, I'll say on day one the price is exactly here at 100. I'm gonna use the green color for this, right? And then on day two, the price managed to get to 200. On day three, it's at 300, 400, 500, and so on, right? So here, that's my level. Here, that's my level, right? That's my level here, and that's my level here, right? And so on. So what happens here, you have a price that is in an uptrend. the price is increasing. So this line is what I mean when I say chart, right? So I can show you a different price action. Let's say, for example, I'm gonna use a different color for this. Let's say I use this, okay, where it did not go straight up like this, but what happened is you did something like that, then it came down here, did this, right? And then that until it ends up at the same level at the end. That too is a different way for the price to get to the same point, but with a little, ups and downs along the way. In fact, that is mostly what's going to happen in the stock market. It never really goes up in a straight line like this. It it always has these ups and downs along the way, and then at the end, it's way higher than it was at the beginning. So if you were to buy something here, right, and it got to this level of 300 on day 2, and you see on day 3 it's coming down, maybe you're like, maybe I'm gonna lose money, maybe I should get out, right? But there are techniques you can use to determine whether it's gonna go back down here, or if it's just a little bit of down, but then it's gonna keep going back up, right? And that's where you can be wrong or you can be right. If your prediction was accurate, then it goes back up, then you make the profit. If your prediction was not accurate, you think it's gonna go back up, but it did not and it goes down, then you may lose money, right? So that's why the techniques we give you will help you maximize the number of times you can be right. Okay, and that's how you make money, because you're not gonna be right 100% of the time, but if you can be right most of the time, you will end up making money. The other thing is, you don't take great position sizes. Like if you have $1,000, let's just go with the minimum. If you have $500, when I say minimum, you can start with 100 if you like, but 100 is gonna make it very difficult to start making money and stuff like that. But so if you can start with 500, that's pretty good on your trading account, right? So let's say you start with $500 and you think Apple is gonna go up a lot, and you take the entire 500 and you put it in Apple, what happens if you're wrong? You lose everything, then you can no longer trade, right? So that's why we advise people to not put, do not put more than 10% of your account into anything, right? Into any single trade. Don't put more than 10% of your account on that. The reason is if you go wrong, if you are wrong, then you only lose 10% of your account. That is not only psychological, but it's also, it is not hard to make up, to grow your account by 10%, but to grow your account by 50% or more, that's very hard. So if you lost 10% of your account, it would not take you too much time to grow it back to that level again, right? So that's why we are saying that. And if you don't go by those rules and you are lucky the first time you did that, you made a good profit, lucky you. But one of those days you will be wrong and it will wipe out your account. And let me tell you, before I became successful in this, I lost a few accounts. I did not have those rules, to start with. I only took a course on how to do, how to place trades and how to buy, how to sell, those kind of things at the beginning. That was like 5 years ago, and I lost a few accounts before I was able to see any money in this business. So and any people, anyone you would hear online who would teach this, they will tell you the same thing. The size matters a lot, right? Very important. Okay, so next, what is a typical um, chart actually looks like? If you use Robinhood, you are likely to see lines like those that I just showed you, right? But you can have a richer chart than just lines. Because what happens is, let's say I told you on day on day 1, let's say you have a line, right, like this, to represent the movements of a company's price. And this is day 1, and you have day 2 and day 3 and so on, right? So at this point here, okay, let's say day 2. So at this point, let's say this was a $200 level. It only means that they closed at the $200 level, right? And this day closed at the $300 level. And this closed at the $400 level, for example, right? So it's only telling you at what price the day closed. But the day has many hours in it, many hours of trading. And the price did not stay in one place for the entire day. It only closes at that level. But during the entire day, you have a lot of movements being done until it closes at that level. So now if you can have an idea of what those movements were during the day, it can help you predict better what may happen the next day, right? For that reason, there was this thing that the Japanese invented, and they called them candlesticks, right? So those candlesticks, they are created like this, okay? Like this. And if you have enough of them, you create a chart, right? They can be two colors, green or red, right? So that's a green one, and this is a red one. Let me get rid of this so I can explain more about those. So these are very important. You're gonna find those always when you are doing trading. If you use Robinhood, you will not see those likely. Maybe you do, but I did test Robinhood account, and even those are not the conventional way, even if you see them. So I'm not gonna promote Robinhood here because it's not the best in terms of how much info and accurate they are gonna be. So, okay. So this green candle, it has 4 areas of information that you should know about. But before I do that, let me show you what they look like on a chart, right? On an actual chart. Let me take the platform and show you that. All right, here's the platform, right? And one sec. Okay, so here is one candlestick, here is another one, here's another one, right? And if you were to think about this, this was the price action of the stock, right? As you can see, it's coming down here, goes it going up, down, a little bit up, a little bit down, a little bit up, a little bit down, and then so on, down, and then up, and so on. If I'm gonna zoom, I can show them smaller, and you can see even greater price actions, right? All of that. You can see what the tendency is. So like this tendency is going up, 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 basically, right? But it's not a line. It's made up of different candles next to each other, and how high they are compared to each other, determines whether the price is up or is going up or is going down, right? I think I can find one of them when it's completely going down. Like this, take this one, right? That's completely going down, right? Okay. Now, what are those candlesticks? What do they represent? One of them has 4 areas of data, 4 data points, basically. If it's a green candle, okay? If it's a green candle, then let me reduce my size. If it's a green candle, then this one represents the open.
Okay, go ahead.
Okay, if it's a green candle, this area represents the open. When I say this area, I specifically mean this point here at the bottom of the body. They call the rectangle part is called the body of the candle, right? So the bottom part of the rectangle is the level at which the price opens, meaning that, let's say this candle represents one day, like let's say day 2 in that line before, right? So it means day 2 started at this price, right? And here is where day 2 closed, right? And that will be the close. Day 2 closed here. right? So if you saw the line would only show you that level. When I showed you here, like this here is the close of the day. And so, which means that's the only level it's showing you, the close. You don't know anything about where the day started. You only know about where it closed. But if you're using the candles like this, then you know this is the open, this is the close, right? And those small lines on top or at the bottom, they are called wicks, written like this, okay? So they are the wicks, and the bottom one means that's the minimum price or the lowest price, right? That it had gotten to for the day. And this is the highest price of the day. What does that mean? If I were to try and represent what was happening during that day, I could say, for example, the day started here and then did something like this, went down to the lowest price, then goes up to the highest price before coming down to close at the close level. You see, start here, then went down to the lowest level, right? Then went up to the highest level and then closes here, right? So that's the type of activity that might have happened during that day. It can be other ways too, but ideally, that's what happened that day, right? So I only see one candle and it tells me all that info about what happened during that day. Conversely, for the red candle, it's the same idea. The only difference is um, this here is the open, right? And this is the close, okay? And this one is still the lowest point, and this still the highest point. So the only difference between the red and the green is that in the green, it opens lower and closes higher. In the red, it's just the inverse of that, the reverse of that. Opens higher and closes lower, okay? So if you see your red candle, what do you think? You think the price was kind of like going down that day. If you see a green candle, it means the price was going up that day. In general, of course, right? Okay, perfect. Do we have any questions so far? I'm gonna go back to the platform before I do. Any questions? Feel free to ask the questions now. Okay. All right, so no questions. Let's keep moving. So I'm gonna go to the platform and show you different types of candle that you may see. So this is Apple, and at the bottom here, you will see when my mouse is moving, right? You can see different dates. So this is August 2nd, that was last year. And this one is August 16th, right? I can keep going, September 6th, September 23rd. If I were to take the most recent days, so this was July 2nd, that was Thursday, this past Thursday, right? And this was July 1st, June 30th, and so on, right? And 2020 started here. That was January, where is it? Where is it? Right? Yeah. January 2nd, right? Was the first trading day of the year. 2019 ends right here, and we've got January 2nd to be the first trading day of the year. And as soon as the year starts, you got February, the COVID-19 happens, and look what happens to the price of Apple. It goes from 323. You see the price level written here, right? As I move my mouse up and down. So from some 323 about down to about 256, right? How long did it take? Look at the bottom, you can see the date from February 20th to February 28th. So about 8 days, right? In about 8 days, the price dropped from 323 down to 228. Remember what I was talking about earlier. Why did it go down? Because of fear. Fear of what? People fear that Apple would not be able to make money this year or stuff like that, or or lose some kind of market revenue or something. But they feel the value of Apple could have decreased, so they went out and sell their shares right away. And when you sell your shares, when a lot of people sell their shares, that's what happens to the price of the stock. And when it gets down to that level, people are like, "What? Wait a minute! This is Apple. This is like what does it do? It's a technology company, so no matter what, it's gonna be able to work." And then of course, and there was a little bit of um, optimism, towards what may happen next. People are starting to, I mean, governments are starting to um, mandate people to wear masks and stuff like that. So yeah, and then some optimism came, and then people buy it again. So then the price will go up. Oh, sorry, it won't even lower before going back up, right? But then from here, from that point, it was going higher and higher until today. It went to an even higher point than it ever was even before the COVID-19, right? So if you were to buy Apple at that level to 12 and it reached that point with you, you would have made, 100, what is it? $182 profit, I think, right? On no, maybe more. Anyway, I'm wrong. But yeah, I think 282. 182 dollar profit on each share that you purchased, right? All right. Very good. So how do you, this is, by the way, this is the software of TD Ameritrade, right? And you are looking at the chart area. Later in a different session, different webinar, I will show you guys how to buy something, how to sell something. But what I want you to see is the different shapes um, of stacks, of candles here, right? So I'm gonna take a screenshot so I can draw on this. Let me show you. So you see this, I'm gonna put it here. Let's take a new one. Okay, so let's say you have this, right? I did show you earlier, like those are candlesticks. You see the length of the wick above is the same as the length of the wick below, and you have the body being a decent size, the body of the candle, right? And I told you if it's red, it opens at the highest point of the body and closes at the lowest point of the body. If it's green, then it's just a reverse. Opens at the lowest, closes at the highest point of the body. And those wicks still shows you the highest point, right? And the lowest point. Okay. But when you go on that brokerage platform, you see different shapes, right? So let's take this, for example, this candle. Oh, let me use a different color. Let's say you take this one, right? This candle. The body is kind of short, and the wick above is kind of long, and the wick below is very short, right? And you look at this one, this candle is just the opposite. The wick below is kind of long, the wick above is short, and the body is kind of short, right? So you'll have different shapes of candle. They are still candles, the same definition I gave you earlier, but the length of the body in relations to the wicks, so the length of the wicks in relation to the body will tell you many things, right? Um, for example, if the price was going up and you have this kind of shape where the wick above is long, the body is short, the wick below is kind of short, that could be sign of a price reversal, okay? The price was going up, it gets here, you see this, that means the price is now gonna start going down, right? Or if the price was coming down and you saw, let me see if I can see, I'm not seeing it here. but maybe here I can see it. Okay, the price was coming down, and you come down here, you see this, where the wick below is long, the body is short, the wick above is short, right? You see that, and the price was coming down. It's sign of a price reversal. That means from here, you can expect the price to start rising, right? So if you wanna buy to make some profit, that could be your entry point, because the price is gonna go higher from there. You can be wrong sometimes, but most of the time you're gonna be right. Okay. So that's just one basic way of trying to predict what the market may do next. And if you know what it's gonna do next, you're able to place yourself in a position to profit from the next move. Yeah. Okay, so this is it for today. Um, I if you have any questions, please ask them now. Otherwise, I'm just gonna tell you how people succeed in the market. Please stop me for any questions if you have any. How do people succeed in the market? You know, let me um, put this out here. Okay, so these are the main reasons why people fail or how you can succeed, right? So 90% of people fail because of lack of discipline. What do we mean by discipline? Risk management. The risk management is nothing but what I was talking about earlier, the size. If you have a $500 account, then don't put the entire 500 into one trade, because if you do that, you're very likely to lose. I mean, let's say you're very likely to fail, because you cannot avoid losses at 100%, meaning even if you were to avoid losses at 90%, so 10% of the times you will lose, right? So if you allow yourself to lose 100% of your account, then even if you lose one time, you're out of business, right? So that's what we mean by risk management. The other thing is about following your plan. One thing you guys might not think about is emotions. Emotions play a very important role in your trading, because what's going to happen the minute you enter a trade, the minute you buy a slice of Amazon, the minute you buy a slice of Apple, emotions are going to kick in. You're gonna be like, oh my gosh, I want this to work. I want this to work. I hope it works. And if it starts going the other direction, I mean, against you, you're like, oh, maybe I should sell. Maybe I should sell. You know, or maybe let's say it's going in your direction and it gets really high. Like let's say it gets to you're already at a profit of $100, right? And you're like, oh, this is a lot. Okay, so $100. What should I do? Should I sell now or should I keep it? Okay, I think I'm gonna keep it because I think it's gonna get to 300 profit, right? And you keep it, and then all of a sudden it goes down to less than when you bought it, and then you're negative now. You're gonna lose money on it because you left it there. So what we mean by following your plan is before you enter or trade, you make a small analysis. You see, okay, I'm going to enter here because I think it's going to get there. So when it gets there, I'm going to sell and get out, take my profit and get out. If it goes against me, I will not let it drop below that level, right? So you have a plan well set, but once you are in a trade and you get to the point where you made the profit you wanted to make, and you should have exited at that point, but because of emotions, you get even more greedy than before. You're like, I can't, I'm gonna wait. And instead of it going higher and give you more profit as you are wishing, it goes lower now. And then you lose, not only do you lose some of the profit you already made, but you lose some of your initial capital that you invested in that, right? So because of that, people lose money a lot when they shouldn't have lost anything. So if you follow your initial plan before you enter the trade, you're more likely to get rid of those emotions that are going to invade you once you are in the trade, right? So follow your plan, your entry and your exit. That will help you make money. That's part of the discipline aspect of it, right? The other thing is not all the money in the market is yours. So you do not need to take advantage of every opportunity you see, right? So you just finish the trade right now and you see another one, you quickly jump into it, or you want to jump into 10 companies at the same time, right? Don't do that. If you do that, you are going to lose money as well. Why? Not because they're going to work against you necessarily, but first of all, you increase your chances of them, of one of them at least working against you. Second of all, you are not going to be able to effectively monitor them all at the same time equally well. You're going to lose focus on one and focus on on another, and the one that you lost focus on probably at the moment is going to go against you, and you're not going to realize that because you are managing too many things at the same time, right? I would advise you guys, as you get started, do not trade more than one thing at a time. You get a good setup, you realize this is going to do what you think it's going to do, and you get in and wait for it to work and get out of it before you enter another one. Don't try to buy too many things at the same time, right? All right. The other thing is there is no rich quick game here. So if you are thinking about getting rich quick, this is where I mean, you should not be here. That's a lottery mindset. You know, you do not get rich quick in this thing. If you think that's what's gonna happen, that's how you're gonna lose money as well. Because how do you think when you think you need to get rich quick? You think, okay, I'm gonna invest as much as I can because, of course, the more money you invest, the more money you can make. That's the math you will do. And you invest everything you have into that one thing because you think that thing is gonna multiply your money by 1,000, right? So you just put everything in there and then it goes against you, you lose everything, right? So that mindset will override every other kind of discipline you might wanna you might have applied, and then you're gonna lose money that way, right? Now, how do you make money? um, you first need the right education, right? Know about the different rules. There's what they call the PDT rule. We will talk about that at a different time because our time is about to be over. And also learn about the strategies that you can use, right? There are different strategies. um, I just showed you something about those shapes of candles. That's not enough yet for you to just go out there and buy anything yet. Don't do it. We'll tell you at what point you should start doing something. But for now, um, come to the webinars, and if you have questions, ask them. And even during the week, if you have questions about anything, just let us know. Okay. So the right education, the strategy you can use, and also the right tools. That's not here, but the right tools. The right tools is depending on what your goal is. Maybe um, um, Robinhood is not the right tool for you. Maybe TD Ameritrade is gonna be the right tool for you, right? And when you dive deeper, you'll find out which one is best, right, for you, for your situation. Okay, guys. Well, I think that's everything for tonight. Do we have any question at all before we close it? Okay, I think we don't have any question. Thank you for coming, and we will do another one next Saturday, and another one on Sunday. So that's how we'll do it. Saturdays and Sundays we'll have webinars, and this today starts the new series of everybody who's new or who wants to restart from scratch. Thank you guys for coming, and have a great night.